The stock market's emotional whiplash continues. Just when investors braced for more turmoil, a sudden rebound has everyone questioning what comes next. But here's where it gets controversial. Can a single social media post truly dictate the fate of billions in market value? Following Monday's impressive rally, stock futures showed almost no movement overnight, essentially pausing to catch their breath after the dramatic surge. To put it simply, futures are agreements to buy or sell stocks at a future date, and they often indicate where traders think the market is headed when it reopens. Right now, they're signaling uncertainty. The previous trading session had brought welcome relief to Wall Street. The S&P 500, a key benchmark tracking 500 of America's largest companies, rocketed up by more than 1%, delivering its most powerful single-day performance since late May. Think of it this way. After a steep fall on Friday, the index managed to reclaim half of that lost ground in just one day. Not to be outdone, the Dow Jones Industrial Average also surged over 1%, marking its best day since September and decisively ending a 5-session slump. It recovered a remarkable 2/3 of its Friday decline. So, what triggered this sudden burst of optimism? The catalyst appears to have been a post on Truth Social from former President Donald Trump that directly addressed simmering investor anxieties. His message, "Don't worry about China, it will all be fine," acted like a pressure release valve for the market, specifically easing fears about a further escalation in trade tensions between the world's two largest economies. This single statement had an immediate and powerful effect, particularly on the technology sector. And this is the part most people miss. The influence of sentiment can sometimes outweigh hard economic data, at least in the short term. Buoyed by the more hopeful outlook, shares of major tech players like Oracle, AMD, and Nvidia experienced broad-based buying, propelling the tech-heavy Nasdaq Composite to a stunning gain of more than 2%. This leads us to a critical point of debate. Ulrika Hoffman-Burchardi, global head of equities at UBS Global Wealth Management, provided a more cautious perspective, noting in a client note that trade policy remains a key driver for U.S. financial markets this year. She pointed out that last week saw a sharp re-escalation in tensions and warned that with positions hardening on both sides, we should expect more stock market volatility. However, and here's the controversial counterpoint, she also suggested that history shows these confrontations between the U.S. and China often lead to tactical truces, where a deal might be struck by trading concessions on items like China's rare earth minerals for U.S. shipping fees. Looking ahead, investors are now turning their attention to corporate earnings to see if the momentum can be sustained. All eyes are on major financial institutions like J.P. Morgan Chase and Goldman Sachs, which are poised to release their third-quarter earnings reports. Their results will be a crucial test, revealing the underlying health of corporate America beneath all the trade war headlines. So, what do you think? Is this rebound a genuine turning point built on solid fundamentals, or merely a temporary relief rally driven by political rhetoric that could vanish just as quickly? We've seen how powerful words can move markets. Do you believe this is a sustainable strategy for long-term growth, or a dangerous precedent? Share your thoughts in the comments below.